Upadhyay, and we have a very special guest joining us today on the show, Dr. Marc Faber, editor and publisher of the Gloom, Boom and Doom report. Dr. Faber, thank you so much for joining in. You know, before I throw my first question open to you, I just want to tell viewers about this monster rally that's taken place in Asia today, particularly in Japan. Let's just pull up those indices. We have seen an 800-point move on the Nikkei. In fact, that market went home with gains of almost 6%. Others in the region were absolutely following suit and were in sync, whether it's the Hong Kong or the Kospi, whichever one you're looking at. And we've, of course, taken our cue from there. The Nifty itself has reclaimed 7,400. So, Dr. Faber, it's been sparked by Mr. Mario Draghi last evening once again, the ECB hinting that there could be a review of their monetary policy stance. But you have predicted, and this is what I've captured in some of the commentary that you've made in the recent past, a 40% crash in stock prices. Do you stick to that view?
Well, what I said is that the market in the US would decline by between 20 and 40% from the high reached last May, which was on the S&P 2,134. And I also told you 6 months ago, actually to CNBC India, when the Indian market was still close to 30,000, that I expected the market to decline to around 24,000.
Dr. Faber, how do you read the picture right now? You are bearish on China, and I don't think that 6.9% GDP number is something that you were in agreement with. Now we have central banks hinting at some kind of action. There are experts talking about action in Japan and, of course, in the ECB. How do you read this fall that we've seen so far in January and just the overall setup?
Well, basically, the market in the U.S. began to decline a long time ago. If you look at the average stock in the U.S., it is down over the last 12 months by 26% from their highs, the average stock. But the indices held up very well until the end of December, because the indices do not reflect what is really happening in the market. Say, you have an index, you have 500 stocks. If 3 stocks are very, very strong, they can push up the index while 497 stocks go down. You understand? So we have to look at the market beneath the surface. And beneath the surface, there was already a bear market in the U.S. for a long time, for a year or more. But the FANG stocks and maybe another 20 shares, such as Facebook, Amazon, Netflix, Google, and maybe, as I said, another 20 shares, they were driving and keeping the index up. But the typical share has been in a bear market. And the interventions by the central banks have numerous unintended consequences. They lead to rising stock prices, that is true, and to recovery in real estate markets. But for many people, this is not favorable because, particularly in real estate, the affordability becomes an issue. They don't have the money to buy expensive homes. And so the home ownership rate in the U.S. has been way down.
But Dr. Faber, are we done with this current rout at least? Do you think we are close to the bottom? How would you read this mega rebound rally that's been underway today in many markets, the US, Europe, and of course in Asia? How do you read today's rally, and how far away from the bottom do you think we are?
Bear markets are characterized by very sharp rallies that then fade relatively quickly. In the U.S. last Friday, we also had a huge rally from the lows. The market still closed down, and it was unusual. This happens very seldom. We had over 1,000 12-month new lows in the U.S. This is very seldom that this happens, and it's indicative that precisely most stocks have been weak for a long time, and it's also indicative that we are in a very oversold position. But the oversold position can lead to a rally, but most likely and I'm saying most likely not to a new high.
So this is just a bear market rally, you were saying?
Yes, I mean, we have, I think the markets will still go lower, but we can have, if the difficulty is, if you print money, basically something will go up. And in the case of the last few years, what has gone up meaningfully are stocks. But as you know, after 2011, stocks did no longer go up. And may I remind you that in US dollars, the Indian stock market is still down 35% from its high in May 2008. That's in US dollars. And we are down last year 27% from the high in early 2015, in March 2015. So basically, if you print money, you can lower the value of your currency, and then you can have asset inflation, but not necessarily in a strong currency.
Dr. Faber.
So the emerging market, hello?
Dr. Faber, if I could just come in there, since you brought up India, a lot of the optimists here and even around the world are categorizing this market as perhaps the best place, at least in the emerging market basket. What is your specific call on India? How much lower do you think this market can go? And would it make sense for, contrarians to actually start deploying any money in India right now?
Yes, I mean, I would say, personally, I think India may still go down to around 20,000. That's possible. That's another 20%. In a volatile world, 20% is not a big deal. And I think that eventually the market will go higher in India. But it will obviously depend on monetary policies. I prefer India to have a relatively tight monetary policies as they are practiced under Mr. Rajan, who I think is the best central banker in the world. Because if you keep money relatively tight, the currency is relatively strong. And this has happened in India. This is the best for India to have a relative strong currency. The stock market is not important for the average Indian because the maximum, a few percentage of the population owns shares.
So you're saying the Sensex can go down to 20,000. Let me quickly now take your views on how you're reading China and how you're reading oil. And I'll tell you this, I was listening to some commentary from Davos that was coming yesterday. The COO of Goldman Sachs says the world is perhaps reading the oil market wrong. People are saying that the oil fall or the collapse in prices is an indication of weakness in the economy. It's not really a problem in terms of demand. It's actually oversupply, which has driven down oil so much. So therefore, why are we getting so bearish? How do you react to some of these views? And of course, how are you looking at China in the context of this commodity collapse?
Well, first of all, I'm not predicting that the Indian market will go to 20,000. But I think it's a possibility that it will go down to 20,000. But as I told you, I think a 20% decline in a volatile world is nothing. So from a longer-term perspective, I think it's probably quite a good time to start buying some Indian equities. Secondly, my advice to all your Indian viewers is this. Don't listen to the people in Davos. This is the establishment. They all lie. They are all misinformed. They all pursue an agenda, so don't even listen to them. These are the same people that 2 years ago told the world that China was growing rapidly and expanding, that resource prices would go up, and so forth and so on. So their credibility is undermined. And that's why we have in the U.S. candidates like Mr. Trump, who I don't particularly like, but he has appeal because he attacks these elites that gather in Davos and do nothing but talk a lot.
So you're saying don't listen to people in Davos. Fine, we will keep that in mind as we get more and more of those views, Western views largely. But coming back to China, I think you are one of the people who has the most bearish view on that economy. You're saying 4% is the actual rate of GDP growth. If China goes into a tailspin, that is terrible news for everybody, including us here in India. So very quickly, do you think the oil market is close to its bottom? And what do you think we can expect from China over the next couple of weeks and months?
Basically, the Chinese economy is much weaker than the government is telling you. The economy at the present time is growing at maximum 2 to 4%. And China, like India, is a huge empire, and some sectors of the economy are expanding and others are contracting. But in general, we have a colossal credit bubble in China. Credit as a percent of the economy has expanded by over 50% in the last 6 years. And this credit bubble has to be deflated one way or the other. India, in this respect, is in a better position because we don't have that kind of a credit bubble. We also have some excessive credit in some sectors of the economy, but not to the extent China has. And in my view, the Chinese economy, and you just have to look at imports and exports from Taiwan, from South Korea. These are relatively reliable statistics. Then you look at the Baltic Dry Index, at freight costs in China, at electricity consumption, and everything points out that the economy is not growing at 6.9%. This is complete nonsense. But of course, it's published by the government. That's what I'm telling you. Don't listen to the diverse people.
All right, Dr. Faber, always a pleasure talking to you. Thank you so much for joining in and taking out the time today. So that is Dr. Doom. He does say 20,000 on the Sensex, but he's saying perhaps selectively you can start deploying because you can't really time the bottom. Otherwise, he's still very, very bearish on the U.S. market, expecting the S&P 500 to retest earlier lows, perhaps translating into a 30 to 40% collapse in U.S. equity prices. Not convinced about more printing from central banks at all. Like Mr. Rajan, says he should keep monetary policy tight here in India.